Hi Shane, good to see you this morning.
Good to see you too, Olga. How are you?
Good, thanks. I thought today we could talk about how DyeCo help small businesses and how we help small businesses, and how we both work together for businesses that are in stress, what DyeCo can do for those businesses, and how you and I over time have helped a number of different businesses, whether it be you're helping the company and we're helping the individual, or whether there's clients that you see that we're best placed to help, or that we see companies that need DyeCo services. So I thought we'd chat a bit more about that today.
Yeah, absolutely. Looking forward to it.
So I thought maybe you could give us some pros and cons, if you see people with tax debt and other debt about a small business restructure, and then I might jump in as well about how we would fit into that situation too.
Yeah, no, absolutely. And yeah, it is one of those things where people think that we can just wave a magic wand and tax debt disappears. And I guess you probably get that more than we get that. Yeah, so it comes into having a whole bunch of different uh, tools at our disposal, some informal, some formal. And one of the formal arrangements that got introduced during the pandemic at the start, one of Josh's reforms was that the small business restructuring, which you touched on. So, yeah, so we've seen a few businesses now coming through that are looking and are eligible for the small business restructure. Effectively, you've got to have less than $1 million in debt, and lodgements and that should be up to date, and entitlements. But the main difference around a small business restructure is that the director of the company remains in control during a restructuring process. So what they do is they appoint an appropriate person to look over the plan, which is usually an insolvency practitioner. There is a special class of liquidator that can look at this sort of things, but the ones that are the registered liquidators that have always been able to do restructuring work still do the restructuring work under a small business restructure. But effectively, what happens is the directors remain in control. They continue to trade the business. They continue to have the exposure, and that's one of the pros that directors see. And it's also a pro in terms of benefits that could be available for creditors, because we're not incurring the same level of costs that would have otherwise been incurred should we be trading on a company under a voluntary administration regime, which means that we would be in there incurring the debt ourselves. And obviously, when you're taking on liability as and personal liability as a liquidator, you make sure you're doing a lot of work to make sure that debt being incurred can be repaid, because the last thing you want to be doing is writing checks out of your own pocket. So there's a increased level of oversight and an increased level of investigation and work that goes into voluntary administration, which just isn't present in a small business restructure. Which means that they can put an offer to their creditors, and that offer can be accepted or not accepted. If it's not accepted, the company reverts back to its continued registered status and continues to go. And if it is accepted, then those debts are sort of part of a pot, which may be payable over time. It might be an upfront payment, whatever the plan reads. So most of the ones that we've done so far involve payment over time, because a lot of these businesses were good businesses pre-pandemic, really hit by COVID, increased debts, mainly to the tax office. Those debts now need to be repaid back over time from returning to profitability, or now that we're back in profitability, but just not enough profitability to retire old debt quickly enough. So, yeah, so they do that as a cents in the dollar return. And yeah, they'll be going on over a period of time and paying back those restructuring repayments.
And so I guess where we come in there, if it's just time and it's only ATO debt, I'm assuming there's still, even with a small business restructure, there's still insolvency consequences. And so depending on the contracts or the covenants, or if they're builders or who they are, that there could be a flow-on effect even with a small business restructure. And so that's the circumstances where we might jump in rather than you, if there are flow-on effects and flow-on consequences and they just need the time, where we can help get them the time with the ATO and help get rid of the interest and penalty penalties. Are there certain circumstances where you've seen where a small business restructure might not work for that very reason, that they could be then in breach of different contracts and covenants?
Yeah, absolutely, and you're right. So if it's just purely ATO debt and this needs time, then going through your process first makes a lot more sense. Keeping it out of sort of the realm or effectively you're putting it into the hands of creditors to decide your future. So looking after your own destiny is definitely a way to be going from the outset. But the ones where they don't necessarily work, so take a registered building practitioner, for instance. They have building licensing consequences, insurance consequences that result from external administrations. So once you're in an external administration, these, like the VBA in Victoria, VMIA is usually the major insurer on a domestic building insurance policy. Those insurance policies can kick in and your building licence may be cancelled because there's a ministerial order that does that. And invariably they are. But that's where it can be a bit problematic, and then you've got to have a deeper discussion about what's going on. And again, if it's just a tax debt thing where you need some time, then it might be better off, because of those consequences, it might be better off exploring some of the informal arrangements and using your services to negotiate out of those. And that's just one of the examples. And the other thing too is if you do go into a small business restructure, you have committed an act of insolvency, which then if it doesn't get accepted and it just returns back to the directors, other creditors can then use that act of insolvency to take active steps to wind you up. They don't necessarily need to go down the path of doing the normal statutory demand for payment. They can just proceed to an application.
So I don't think there's a magic wand. So often when we see people, and I'm sure when you see people, I often call it pub talk. There's a lot of pub talk. Oh, well, if you go bankrupt, it will just wipe everything and all your debts will disappear, or you wind the company up and all the debts will disappear. Or we hear a lot of the time, my accountant just got rid of a whole heap of my tax debt. And there are ways we can do it by looking at the interest and penalties, and they are so huge at the moment that often they make up half of the debt. And there are ways, obviously, that you can reduce or get rid of the debt. But I think the key is there are consequences to all of this. So for me specifically, it's very much horses for courses. It's having a look at the client, what the client's going through at that particular time, how many debts there are, whether it's just ATO debt or, as you would see all the time, whether they owe money here, there and everywhere, and then working out which is going to be the best course of action. And then, of course, there's times where you and I have worked together a lot, whereas a company might need to go into liquidation and we're able to help the director.
Yeah, absolutely. Look, we talk, as you said, about the magic wand. There is always a cost. Now, what that cost is going to depend on each person's individual circumstances. And sometimes that there is a cost for the company and a cost for the director. So if we talk about the corporate one, when you go into, so just say it goes into liquidation, and then we have the ability to, as liquidators, to then pursue potentially insolvent trading claims and things like that. Obviously, there's a cost for the director, but in some instances, they may not have lodged an SGC statement. They may not have lodged their BASs within 3 months of their due date, and therefore they're still exposed to a director penalty notice being issued at a later stage, because they're already, as you know, they're already automatically personally liable for that tax debt because it was lodged outside of the time frame specified in the Act. So therefore, they're going to have this personal consequences. So the liquidation is going to get rid of maybe a larger portion, maybe a smaller portion of the debt that's associated with that. And obviously that comes at a cost. And then there's going to be the personal cost associated with the non-lodgement component, the director penalty notice component, which they will then need to deal with personally. Now, their personal position is probably going to be very different. They may or may not have assets. They may not want to go bankrupt. Again, if you're going to be looking after a number of companies or being a registered builder or want to do these things short term, bankruptcy is probably not something that you're going to want to explore very quickly. It's something you're going to want to avoid. And that's where you need to then go into negotiations, whether it be the tax office or other creditors.
And often we see, especially if the company has gone through an active insolvency, whether it's a voluntary administration or however that might work, the director's debt isn't as much as the company's debt. What the portion that the director is personally liable for is lower. So that's where we're able to come in and get them time and a payment arrangement over time that meets their current cash flow. And if there are interest and penalties still sitting around and still sitting there, then we're able to look at getting rid of those as well.
Yeah, no, and the ones that we have worked on they've all been, they've all resulted in great results. For the director coming out the other side, which has meant that they're able to avoid bankruptcy and continue on with still got a cost to pay, still got a price to pay. But that price is the set price, the negotiated price, and it's not the price that's inflated by interest, penalties, non-lodgements, etc., etc.
What are some scary, I know there's sort of some generalisations in the world, but some effects of bankruptcy, from what I understand as well, include you can't travel in certain circumstances. If you owned a house in your name and you went bankrupt, that would be at risk. And I suppose there's a whole heap more, as you mentioned, about whether you hold a building license. What are some other that are possible consequences of bankruptcy that don't necessarily make it the magic wand that people might think it is?
Yeah, so and depending on who you speak to, it's got different levels of scariness because some people think it's like the absolute worst thing that could ever happen. But look, bankruptcy, when it's needed, is designed to put people back on their feet. So yeah, some of the horror stories, yeah, you can't travel. Not exactly correct. Yeah, you can. You need to be up to date with your income contributions. Income contributions are the ones that once you start earning over a certain amount, depending on the number of dependents that you've got, which is currently, I think it kicks in roughly around 62 grand. Actually, I could probably bring it up and give you some exact figures. But it's on the AFSA website. It's under the indexed amounts, current amounts, and it starts at around 62 grand net of tax. So gross it up, net of tax and deductions, and then it goes up from there. After 4 kids, you don't get any more bonuses. So if you've got 4 kids, stop. You don't need the extra deductions. But yeah, so providing those things are up to date and you're being compliant with your trustee, travel's usually not too bad. Travel for work is still something that can be done. That's not a problem. House, yes, if you're a joint owner of a house, that could be exposed, which is most people's first concern is, will I keep my house? A lot of factors come into whether that's problematic or not, including how much equity is left in the house, how much you contributed to its purchase, have you been paying for the ongoing, and even if you aren't necessarily on title of a house, there is still potential exposure there for the house. If you've been the one paying the mortgage, you might have what's called an equitable interest in that house that your trustee then might seek to do. But usually what happens is if there's a non-bankrupt spouse, a trustee would negotiate with them. But yeah, other things that, as we mentioned, the building license, there's limits on tools of trade, there's limits on motor vehicles, which usually you'd talk to your trustee about. So the limits are around 3.5 and 8.5. 3.5 for the tools of trade, 8.5 for the cars. Those numbers don't mean that you have to have an $8,500 car. It just means that you can have a $20,000 car. You just need to owe more than 12 grand on it. So it's that difference. It has to be less than around about 8.5.
So there's a whole heap of nuances, I suppose, as well. So that's like when we get involved, if the debt is manageable and if they need more time, there are benefits, I think, for negotiating, as well as in some circumstances benefit with the bankruptcy. But it's about getting the right help, the right information, and not just jumping into these things blindly because you're in a panic without having the right people helping you.
Yeah, no, you've always got to go and get specialist advice, whether it be tax debt negotiation or if you're considering bankruptcy. It costs you nothing to come and have a chat and understand what your options are. Same with you. It costs them nothing to understand what you can and can't do for them. And the best thing you can do is, if we can't help you or we're not the right people to help you, because it might be that we need to refer it to you, or the exposures are too great and the debt's maybe not enough, because some people just they want to go bankrupt and they're struggling, but it doesn't really make a lot of sense for them. So, if you've got a 20-year-old with, 20 grand's worth of credit card debt, you're not going to recommend that they go bankrupt, because it's going to have repercussions in terms of their ability to borrow in the future. And it stays on your permanent record. If someone does a national personal insolvency index search, it'll show up that they were a former bankrupt and they've been discharged. So it's always, but the same person at 80 that has 20 grand of credit card debt and they've got a pension, you might get there and say, well, you're never going to pay that back from the pension. You can let someone chase you, or you can go bankrupt if you so choose, because they're not going to borrow again in the future if they don't own a home and they're renting or whatever the case might be.
So I think too, it's not one size fits all. So for you and for us, it's never one size fits all. It's very bespoke about what the company might need at the moment, what the individual might need, what tax liabilities are up to date, what's lodged, what's not lodged, whether the company's paid their super, whether they haven't paid their super. So it's finding all of that out at the beginning and then finding the best possible outcome or the best possible path for them based on their circumstance.